What's up, guys? In today's video, I'm going to share with you why I believe SCHD is back and why I'm going to be putting a lot more money into it, and I think you should too. So first off, SCHD is 31.2% of my entire stock portfolio. So I really do believe in this ETF. As you can see, I have almost $20,000 in it, and my portfolio's current value is over $63,000. So now going into why I believe SCHD is the best ETF and why it's going to continue to grow. If we just look at SCHD year to date, it's up 7.21%. And while that is significantly underperforming the S&P 500, you can't complain about a 7.21% return. And I believe SCHD has plenty of room to grow for the rest of these last 4 months of the year. Next, I want to show you the dividend scorecard for SCHD on Seeking Alpha. And if we scroll down, you can see it has a current forward dividend yield of 3.44%, which is a high dividend yield for SCHD. Usually it was sitting around the 3%. So this is a great starting yield. Plus, when you add the 5-year growth rate of 12.88%, that is massive. That is an insane growth rate, and it's been able to maintain that for 5 years. And in fact, they've had 12 years of dividend growth. So even though SCHD is underperforming the S&P 500, that's not the only reason why you shouldn't buy it, but this dividend growth is a reason why you should. And then next up, I just want to show you the top 10 stocks for SCHD. So number one is Lockheed Martin. Then you have AbbVie, BlackRock, Home Depot, Cisco, Coca-Cola, Amgen, Bristol-Myers Squibb, Texas Instruments, and then Pepsi. So these are all solid companies. And then next up, I want to go just some key points of why I believe SCHD is great. Number one is their rules. So I'm going to go over these very briefly. This is what SCHD requires: 10 consecutive years of dividend payment. They also have a minimum liquidity requirement, and this eliminates those small, undependable companies which might not maintain and then grow their dividend. Next, they prioritize debt-free companies. They screen for positive free cash flow. They require companies to have 5 years of dividend growth. And then this captures the most recent dividend increases, whereas 3 years might not be enough data, or 10 years might not capture bad years where they had low or no dividend growth. And then they also require that no more than 4%, that you own no more than 4% in a company or 25% in a sector. Next up is interest rates. They're currently, the interest rates looks like they are going to be lowered starting in September. And I believe with these lower interest rates, there's a high chance of that 25 basis point rate cut. And this should funnel money into SCHD with a flight to safety. Investors will be looking to get away from big tech and put their money into those small and mid-cap companies that, like we had just mentioned, in the top 10 of SCHD. And guys, with that being said, this is just a short video. Thank you for watching. I'll see you next time.